What if I said one of the most powerful wealth building tools today is also one of the most boring? Alright, let's talk about SEHD. It's not flashy, it won't make you rich overnight, and that's exactly why I use it. I'm here to show you how I'm building wealth with SEHD. No hype, just facts, real numbers, real results. And a quick disclaimer, this is not financial advice. I'm sharing my own approach, backed by actual performance data. Most people fail at investing, not because the market is risky, but because they get bored and quit too soon. So, why SEHD? Because it's built on quality, because it keeps paying even when the market gets ugly, and because boring works, if you give it time. Today, I'll walk you through exactly how I use SEHD to grow steady income while staying sane. Chapter 1. Why SEHD? It stands for the Schwab US Dividend Equity ETF. Sounds complicated, but here's the simple version. It's a basket of around 100 US companies, not just any companies, ones with a proven history of paying and growing dividends. Schwab rebalances it once a year. That means every year, it checks each company's financial health. If it doesn't meet the rules, it's out. Only strong players stay in. The rules? High return on equity, low debt, sustainable dividend payouts. Some big names inside right now. PepsiCo, Home Depot, Cisco, Texas Instruments. These aren't hype stocks. They're steady cash flow machines. The expense ratio is tiny, around 0.06%. That means almost all your money stays invested. It pays dividends 4 times a year: March, June, September, and December. You get cash in your account, or you can reinvest it. And here's the beauty. By buying SEHD, you get diversification. One ticker, dozens of strong companies. One decision, many income streams. Chapter 2. My investment approach and mindset. I didn't buy SEHD to beat the market. I bought it to build stability. Before SEHD, I chased growth stocks. I checked my account every day. It was stressful. One bad earnings report could ruin my week. SEHD changed that. It's boring, and that's a good thing. I see it as my foundation, the base of my income portfolio. Other ETFs can sit on top of it, but SEHD is the core. My plan is simple. I hold long term. I reinvest every dividend. I buy regularly, even when prices drop. And here's the mindset shift. I don't care about daily prices. I care about the income. If the dividends keep coming, the plan is working. This approach gives me peace, and peace in investing is underrated. Chapter 3. Real numbers. My SEHD results so far. Let's get into the numbers. I started with 100 shares in October. Price? About $85 each. That's $8,500 invested. Then came the 3-for-1 stock split in 2024. Now I had 300 shares at around $28 each. Same total value, smaller price per share. More flexibility if I wanted to sell or gift shares. Before the split, dividends were about 70 cents per share each quarter. That gave me around $70 every month. After the split, payouts adjusted to about 23 cents per share. But remember, I now had 300 shares, so the total stayed the same. First post-split dividend, $69.21. That's money my money earned. No selling, no trading, just holding. By the end of the year, I had 309.38 shares. That's thanks to DRIP. Every dividend bought more shares. Total after 1 year, capital gains, about $178. Dividends, $290.91. Total gain, nearly $470. That's a yield of roughly 3.4% plus growth. It's not flashy, but it's predictable. And that's the point. While tech stocks jumped and crashed, SEHD just kept paying. Calm, steady, boring, and exactly what I wanted. Chapter 4. How much SCHD to reach specific income goals? Let's do the math. You want $100 a month from SCHD? That's $1,200 a year. Now we look at yield. SCHD's yield in mid-2025 is about 3.5%. So $1,200 divided by 0.035 equals around $34,300 invested. But yields move. If it drops to 3%, you'd need $40,000. If it rises to 4%, only $30,000. That's why I add a margin of safety. If I want $100, I aim for $110 or $120. And here's the scaling. $100 per month equals $34,000 invested. $500 a month, $171.5 thousand. $1,000 per month, $343,000 invested. Same formula every time. One more thing, SCHD pays quarterly, so you won't get $100 every month exactly. You'll get bigger payments 4 times a year, but averaged out, it's your monthly goal. Once you see the math, it's clear. It's just a game of capital, yield, and patience. Chapter 5. Scaling with Consistency. My weekly and monthly contributions. I don't just wait for my portfolio to grow. I feed it. My system? $100 a week. That's $5,200 a year. If the market returns 7 to 8% long-term, that grows fast. After 10 years, you could have about $75,000. After 20 years, around $250,000. And here's the key. I don't stop during downturns. When prices drop, I'm buying more shares for the same $100. That's dollar cost averaging in action. I also turn on DRIP. Every dividend buys more SCHD automatically. These new shares earn dividends too. This creates a snowball, small at first, then bigger, and faster. I like thinking in milestones. Year 5, maybe I hit $100 per month. Year 10, maybe $250 per month. Year 20, $500 plus per month dollars without lifting a finger. It's math plus discipline. And yes, $100 a week sounds small, but small plus consistent beats big plus random every time. Chapter 6. The Role of Dividend Growth and Compounding. SCHD doesn't just pay dividends, it grows them. In 2013, it paid about 84 cents a share for the year. In 2023, it paid $2.68. That's more than triple in a decade. If you held that whole time, your yield on cost skyrocketed. The same shares now pay you much more on your original investment. Now mix that with DRIP. Each payout buys more shares. Those shares pay their own dividends. It's a feedback loop. The magic? After you hit your first income goal, growth speeds up. $100 per month might take years, but getting to $200 per month? Much faster. That's the compounding curve. It rewards the patient. And that's why I stick with SCHD. It's not just income today. It's income that keeps climbing without me adding extra work. Chapter 7. Risk Management and Diversification. SCHD is strong, but no single ETF should carry your entire portfolio. It focuses on US large-cap dividend payers. That means less exposure to small caps or international markets. I pair it with other ETFs. VYM adds utilities and real estate. JEPI gives monthly income using covered calls. This spreads risk. Different holdings, different payment schedules, different strategies. I also watch for overlap. SCHD and VOIM share about 30% of the same company. JEPI, very little overlap. The goal isn't just more tickers, it's complementary ones. And here's the truth. Chasing the highest yield can be dangerous. Funds like QYLD may pay big now, but can hurt long-term growth. I avoid that trap. Instead, I build a balanced system, one that survives bad markets and thrives in good ones. Chapter 8. Taxes and Account Types. Most SCHD payouts are qualified dividends. That means they get taxed at 0%, 15%, or 20%. depending on your income. If you want to avoid taxes now, hold SCHD in a Roth IRA. There, dividends grow and withdraw tax-free. In a taxable account, timing matters. You need to hold shares for 60 plus days around the ex-dividend date to qualify for lower tax rates. I split my approach. Some SCHD sits in my Roth for the future, some in taxable accounts for flexible access. Either way, I plan for taxes before I spend a single dividend. So, why SCHD? Because it works quietly. It grows income over time, and it doesn't require daily babysitting. My approach is simple. Invest consistently, reinvest dividends, diversify smartly, and think in decades, not days. The numbers prove it works. The mindset keeps me in the game. If your goal is $100 a month, start now. If your goal is $1,000 a month, keep going. It's just capital, yield, and time. And here's my last point. Most investors lose because they quit when it's boring. But boring is where the compounding happens. Your next step? Run your numbers. Set a target. Start building. Because the earlier you plant the seed, the sooner you get to enjoy the shade.